Welcome and thank you for joining us for part 7 of the series Unpacking the World of Hedge Funds. Today, we will explore Fairtree's unique approach in the following areas: being the first in South Africa to blend traditional asset classes and hedge funds together in customized solutions, finding the perfect blend to cater for your investment objectives, how hedge funds can enrich your golden years, and as always, the key takeaway for this part. Let's begin. In part 1 of this series, we made the following statement. What most South African investors don't realize is that they, regardless of their net worth, have the wonderful opportunity to include alternative assets in their discretionary investment portfolios, like saving for a house, a child's education, creating wealth over time, and so forth, as well as their pre- and post-retirement portfolios, like retirement annuities, living annuities, etc. Now, you may be thinking, this is excellent news, but how do I go about selecting a suitable hedge fund to include in my investment portfolio? This is a very good question, as there are various hedge funds to choose from. In addition, your personal circumstances, financial situation, risk appetite, and needs are unique and must play a fundamental role in how you put your overall investment portfolio together. Fairtree is the first South African investment manager to follow an exceptional and influential approach to portfolio construction, blending traditional asset classes with alternative strategies and assets like hedge funds. These funds or solutions were specifically designed with you, the investor, in mind to cater for all your financial needs. In other words, we have made including hedge funds in your portfolio not only possible but effortless. The only thing that you are required to do is to match your financial objective with a customized solution. Fairtree has a number of traditional unit trusts and hedge funds to choose from. So how do you go about finding the one that will best fit your investment goals? Let's see if we can find the perfect blend to cater for your investment objectives. It's important to note that we have a different approach to balanced investing than what the industry does. Two of our funds that represent this approach best are the following: the Fairtree Worldwide Multi-Strategy Flexible Retail Investor Hedge Fund, also referred to as a RIF, and the Fairtree Worldwide Multi-Strategy Flexible Qualified Investor Hedge Fund, also referred to as the QUIF. They have specifically been designed to provide long-term investors with the best of both worlds, a blend of traditional and alternative assets to ensure an enjoyable investor journey. The main differences between the two funds are the regulatory aspect we covered in part 1 and their investment minimums: 50,000 Rand for the Retail Investor Hedge Fund and 1 million Rand for the Qualified Investor Hedge Fund. In part 4, Kurt van der Walt made the following statement and said, "To us as portfolio managers, there is very little difference between how the retail versus qualified hedge funds are traded. They hold the same strategies, and hence the retail investor hedge funds with the lower investment minimums are really there to cater for the retail market, giving investors, or let's say the man in the street, also the opportunity to invest in hedge funds." With this in mind, if you have long-term investment objectives, the above-mentioned Fairtree solutions may be the perfect fit for you. Let's look at some of those long-term investment objectives. It could be one or more of the following: my family means the world to me, and I would like to buy a place which we can call home. I've always dreamed about having my own business and need to save up some starting capital so that I can spread my entrepreneurial wings. I believe in the value of quality education, and my greatest wish is to send my children to a reputable university and pay for their tuition fees. I've worked extremely hard to build my investment portfolio over time. I'm set on preserving and growing it over time. A comfortable retirement has always appealed to me. A portion of my accumulated retirement savings must surely achieve good growth to ensure a sustainable income throughout my golden years. Let's look at a case study to see how this will practically play out and how you can match your investment objectives to those of a specific solution. You have saved diligently over the last couple of years by depositing money in a savings account at your bank. Fairtree's Unlocking the World of Hedge Funds series has opened your eyes to a whole new world of investment opportunities, and you're excited to enhance your investment journey. it is your wish to earmark and invest $200,000 of your savings for your daughter's tertiary education starting in 8 years' time. The first step is to ask yourself some questions. This will help you to take all relevant factors into account when identifying a suitable investment solution. You can start with your investment amount. In your case, it is 200,000 Rand currently invested in cash. Secondly, what is your investment goal? The 200,000 must grow as much as possible to pay for tertiary education without taking unnecessary risk. Thirdly, what is your investment horizon? In your case, it is 8 years, and it is important to note that an investment horizon of 5 years or more would be referred to as long-term investing, and you should consider a fund or portfolio that aims to achieve good growth over this period. Fourthly, what is your appetite for risk like? Initially, you felt a conservative to moderate appetite for risk, but you have come to realize the following. Risk has different sides to it and is not synonymous with danger. You must take a certain level of risk to achieve the required level of return, and you can take a high degree of risk over a longer investment period. Fifthly, how about additional contributions? You have decided to do a monthly contribution of 2,000 Rand. And lastly, how about other considerations? You would prefer to have both local and foreign exposure to a wide range of asset classes, cash and cash equivalents, fixed income, property, equities, and other alternatives like hedge funds. The next step is to look at the investment objectives of a solution to evaluate if they align with your own needs and goals. A fund fact sheet, portfolio sheet, or minimum disclosure document will contain most of the information you will need to assist you to make an informed decision. Looking at the disclosure document of the Fairtree Worldwide Multi-Strategy Flexible Retail Hedge Fund, the following is worth noting. We can see that the fund has a medium to high risk profile and also medium to high return generation over a 7-year period. If we look at the fund overview, we can see that the fund is invested in a diversified blend of worldwide assets, including equities, bonds, property, preference shares, money market instruments, listed and unlisted financial instruments. The objective is to provide competitive above-inflation annualized returns, which is measured in Rand over a 7-year period. Looking at the fund allocation, we can once again see the spread when it comes to equity, property, fixed income, equity directional, and fixed income directional. There's a nice split between local and offshore jurisdictions. We have successfully matched your needs and goals with the investment objectives of the Retail Investor Hedge Fund, and you feel confident that they are in line with your own and what you would like to accomplish over the next 8 years. By investing in the RIV, you have peace of mind that you will be able to enjoy the best of what both worlds have to offer. Let's look at another case study, this time of a post-retirement investment portfolio. You were on the verge of retiring at the end of 2015 and were looking for the best possible solution to invest your retirement savings, which you have accumulated over the years, in a retirement annuity. You decided to only take a certain portion in cash and ring-fence it for emergencies. This leaves you with 6 million Rand from which you would like to withdraw a monthly income of 30,000 Rand from before tax. It is of paramount importance that your post-retirement investment portfolio is structured appropriately to allow for sustainable income withdrawals and long-term capital growth simultaneously. The question then is, how do we structure this portfolio? At Fairtree, we see balanced investing differently. Let's compare the standard industry approach to Fairtree's unique post-retirement personalized income portfolio approach, also referred to as PIP. Taking your post-retirement case study, let's see how the industry standard fares against Fairtree's unique approach. The industry standard. You thought of investing your retirement savings very conservatively, as it was the only available funds to provide you with a sustainable income during your retirement years. It's worth mentioning that the fear of taking more risk to see growth usually causes investors to lose sight of another more concrete risk factor: the eroding effect of inflation over the 10, 20 or more years that you will spend in retirement. As each year goes by, the value or purchasing power of your money becomes less, and the only way to counter this is to achieve growth or receive an investment return that exceeds inflation by a generous margin. Upon hearing this, you approached a financial advisor to assist you with taking on more risk to strike a balance between being prudent whilst aiming to achieve good growth. The advisor suggested that you invest your 6 million rand in living annuity consisting of a combination of balanced funds, which are traditional unit trusts, to diversify your portfolio. A monthly amount of 30,000 rand before tax would have been withdrawn from this investment and paid into your bank account to enable you to fund your lifestyle expenses. Let's see what happened with the average balanced fund portfolio. Here you will see your initial investment amount of 6 million rand and also an income withdrawal amount of 360,000 rand for the year. That is of course the 30,000 rand per month for the year. You will also see that your income withdrawals will escalate per annum to be in line with inflation of 6%. At the beginning of 2016, your 6 million rand was invested and you received a return of just over 1%. Of course, your 360,000 rand was withdrawn for the year to give you an income, which left you with a total of just over 5.7 million at the end of 2016. For the next 5 years, you of course received investment returns and also withdrawn money to fund your lifestyle expenses. At the end of 2021, you will see that the value of your investment is now 5,761,000 rand. This means that there has been a decrease in your portfolio value of almost 240,000 rand. This means that your withdrawals have been more than what you have received in return and that you have started to use of your initial investment capital. Your investment has now reached a point where its value will continue to decrease until your retirement savings are depleted. Let's compare this case scenario to Fairtree's unique approach, the Personalized Income Portfolio, or also referred to as the PIP strategy. The PIP strategy was created to allow for regular withdrawals and long-term capital growth simultaneously. This means that your monthly redemptions won't disrupt the growth of the overall portfolio, maximizing your capital's growth, increasing the investment's longevity, and providing you with a sustainable income for as long as possible. Here is a video to illustrate this strategy.
The way that you structure your retirement savings portfolio once you retire is key. You need to strike the balance between growing and protecting your capital. In retirement, many people make the mistake of investing very conservatively, as it is the only available funds providing you with an income during your retirement years. The issue with this is that your retirement portfolio needs growth to ensure the longevity of your income withdrawals. Your expenses during retirement stay the same or increase. For example, take medical inflation, rent or bond repayments, inflation or the cost of living, groceries, utility bills, and so on. So, how do you strike the balance between capital protection and capital growth in your portfolio? Fairtree's Personalized Income Portfolio is designed to allow for regular withdrawals and long-term capital growth simultaneously. This means that your monthly withdrawals won't disrupt the growth of the overall portfolio, maximizing capital growth, increasing the investment's longevity, and providing you with a sustainable income for as long as possible. So, how does it work? Your portfolio is divided into 2 buckets: an income bucket for short-term income withdrawals and a growth bucket for long-term capital growth. The short-term income bucket has a low risk profile, that is aimed to provide you with a return between 2 and 3% above inflation. This allows for regular and stable income over a number of years. The long-term growth bucket is aimed to provide you with the highest possible prudent growth return that is at least 6% above inflation. This growth section of your portfolio is left to grow, undisturbed by income withdrawals. Time ticks on, and your income bucket pays out your monthly income over a number of years until it is depleted. We move the funds from the growth bucket to the income bucket and start again. Fairtree's personalized income portfolio strategy truly maximizes your capital growth, increases the investment's longevity, and provides you with a sustainable income for as long as possible.
Following this approach, or the PIP strategy, your 6 million rand in the living annuity would have been split into two parts: 1.8 million in an income bucket for the short term and 4.2 million rand in a second bucket called the growth bucket for the long term. The objective with the income bucket was to provide you with a regular and stable income over 6 years. In other words, your monthly income amounts were withdrawn from this bucket, in your case 30,000 Rand per month for 6 years. The money was invested in the Fairtree Flexible Income Prescient Plus Fund, a fund with a low risk profile that aimed to provide you with a return that is 2 to 3% above inflation. The balance of your 6 million Rand was invested in the growth bucket with a long-term view of more than 6 years. The objective of this bucket is to achieve the best possible growth, investing in a combination of traditional long-only funds and hedge funds. The money was invested in the Fairtree Worldwide Multi-Strategy Flexible Qualified Investor Hedge Fund, a solution that aimed to provide you with a return that was at least 6% above inflation. Let's see what has happened in the Fairtree PIP strategy. At the start of 2016, your 6 million Rand was invested in your living annuity. 30% of that, or the 1.8 million Rand, was invested in the income bucket in the Fairtree Flexible Income Plus Prescient Fund. The balance thereof, the 70%, or the 4.2 million Rand, was invested in the growth bucket in the Fairtree Worldwide Multi-Strategy Flexible Qualified Investor Hedge Fund. For that year, you have received a return, and you have also withdrawn the 360,000 Rand, which is the 30,000 Rand per month, to provide you with an income. At the end of 2016, the value of your portfolio was 5,975,000 Rand. You continued to invest for the next 5 years, and at the end of 2021, the value of your portfolio was over 7.4 million Rand, which means that your initial investment has increased by more than 1.4 million Rand, regardless of the income withdrawals. This means that the growth on your investment has been more than your withdrawals, and you have not yet started to use of your initial investment capital. It is clear from this case scenario that Fairtree's unique approach, the PIP strategy, has outperformed the industry standard by providing more than 1.6 million Rand in return. This is truly maximizing your capital's growth, increasing the investment's longevity, and providing you with a sustainable income for as long as possible. The key takeaway for Part 7 is simply the following. Your personal circumstances, financial situation, risk appetite, and needs are unique and must play a fundamental role in how you put your overall investment portfolio together. Fairtree has made it not only possible but effortless to include hedge funds in your investment portfolio. The Fairtree Worldwide Multi-Strategy Flexible Retail Investor Hedge Fund, also referred to as the RIF, and the Fairtree Worldwide Multi-Strategy Flexible Qualified Investor Hedge Fund, referred to as the QUIF, have specifically been designed to provide long-term investors with the best of both worlds, a blend of traditional and alternative assets to ensure an enjoyable investor journey. What is next? Be sure to keep your eye on our social media channels on the 23rd of May when we will release Part 8. Two Fairtree investment specialists will answer some topical questions and elaborate on why the Fairtree RIF and the Fairtree QUIF offer the ultimate investor journeys in a single solution.